Variance analysis is one of the most important applications of standard costing systems and forms the foundation of budgetary control and performance evaluation in management accounting. A variance is the difference between the standard planned cost or revenue and the actual cost or revenue incurred. By analyzing these differences, management can identify operational inefficiencies, assess managerial performance, investigate deviations from expected performance, and implement corrective actions to improve organizational effectiveness. Variance analysis, therefore, provides a continuous feedback mechanism linking planning with operational control and supporting evidence-based managerial decision-making. Sales price and sales volume variances. Sales variances measure deviations between budgeted and actual sales performance, and are generally classified into sales price variance and sales volume variance. The sales price variance measures the financial effect of selling products at a price different from the standard or budgeted selling price. A favorable variance, F, occurs when actual selling price exceeds the standard price, increasing revenue. An adverse variance, A, arises when products are sold below standard price because of discounts, competitive pressure, or pricing policy changes. The sales volume variance measures the effect of selling more or fewer units than originally budgeted, where marginal costing is used or standard profit under absorption costing. A favorable sales volume variance indicates stronger than expected demand or successful marketing activities, while an adverse variance may reflect economic downturns, increased competition, supply shortages, or forecasting errors. Together, sales price and sales volume variances explain differences between budgeted and actual revenue performance, and assist management in evaluating pricing policies and market effectiveness. Material cost variances. Material cost variance analysis evaluates purchasing efficiency and production resource utilization. The total material cost variance measures the overall difference between standard material cost and actual material cost. This total variance can be analyzed into material price variance and material usage variance. The material price variance measures the effect of paying a different price from the standard purchase price. A favorable price variance arises when purchasing obtains materials below standard cost, while an adverse variance may result from inflation, supplier price increases, emergency purchases, or changes in material quality. The material usage variance measures production efficiency by comparing actual material consumption with standard material usage. Favorable usage variances indicate efficient material utilization with reduced waste, whereas adverse variances may result from poor quality materials, machine inefficiency, operator error, or excessive spoilage. Labor cost variances. Labor variances assess workforce, cost control, and operational productivity. The total labor cost variance equals the difference between standard labor cost and actual labor cost. This variance is divided into labor rate variance and labor efficiency variance. The labor rate variance measures the effect of paying employees wage rates different from standard rates. Favorable labor rate variances may arise from employing lower-paid workers or negotiating reduced wage rates, while adverse variances may result from overtime premiums, wage inflation, or employing higher-skilled labor than originally planned. The labor efficiency variance measures workforce productivity by comparing standard labor hours with actual hours worked. Favorable efficiency variances indicate greater productivity than expected, whereas adverse variances may arise from inadequate training, machine breakdowns, poor supervision, material shortages, or inefficient work methods. Variable overhead variances. Variable production overheads also require variance analysis because they fluctuate with production activity. The total variable overhead variance measures the overall difference between standard and actual variable overhead costs. This total variance is analyzed into variable overhead expenditure variance and variable overhead efficiency variance. The variable overhead expenditure variance measures differences between actual and expected variable overhead spending. This variance reflects changes in indirect material prices, energy costs, indirect labor rates, maintenance costs, or utility charges. The variable overhead efficiency variance measures whether actual production activity required more or fewer labor or machine hours than standard. Because many variable overheads depend upon labor or machine hours, Improved production efficiency generally produces favorable variable overhead efficiency variances, while operational inefficiencies generate adverse variances. Overall, variance analysis transforms standard costing into an effective management control system by identifying deviations from expected performance and highlighting areas requiring managerial attention. Systematic analysis of sales, material, labor, and overhead variances enables organizations to improve operational efficiency, strengthen cost control, enhance budgeting accuracy, and support continuous organizational improvement through informed managerial decision-making.